if you do have something to say, feel free to raise your hand at any time. And just, again, please stay on mute to minimize disruptions for our speakers. And today our plan is that we are going to briefly go over homeownership investments in the governor's budget. We have a guest speaker from the Oregon Department of Revenue to talk about changes to first-time homebuyer savings accounts. We're going to talk about some exciting program updates and funding opportunities. Then we'll turn it over to you for updates, and then we'll talk about engagement opportunities. So with that, I'll hand it over to Director Giscombe to share some welcoming words.
Good afternoon. Welcome, everyone. It's been a really exciting year of 2024. We got a lot of things that we started the year off of trying to work through, and I feel really comfortable that we're in a great space working in community with you all. And I truly appreciate how all you all show up and support us as we try to help more Oregonians, and especially the space of homeownership. Um, unlike everything great, change is part of it. I would say in November we were able to we had one of our members, Magda, that's moved on to the Equity, Diversity, Inclusion office, and in that process, I know she's gonna do a great job there, um, providing agency support for all the services that she normally provide in home ownership and also in language access. And in her replacement, we also had the opportunity to bring someone on board, and we were able to bring Mr. Sims from an external candidate back into the state of Oregon, and he have an extremely length of experience working in community, working with people in need, and I would like to welcome him into the space, Mr. Gary Sims, and also welcome and also support Magda in her new role. Again, I said we've been doing a lot of great things together this year, and I'm really excited of how we showed up as a team and how you all showed up as stakeholders. So thank you all for making 2024 a really great year in this space. Thank you so much.
Thank you. And I realize a tradition with this meeting is not only that we get to introduce our new staff within homeownership, but also see if anybody is joining this meeting for the first time. So if you want to come on camera and just raise your hand or raise your virtual hand, let us know if this is your first time attending this meeting. We're always happy to have new faces here, and very happy to have old faces or long timers. No judgment on your age. But great. I saw a hand. Katrina, looks like it's your first time here. Welcome. Anybody else? Gary, great. Great, well, welcome. And I am now going to dive into some of the meat of our agenda. So many of you have probably seen that the governor posted her budget for the legislative session. This starts the legislative session, or the legislative session starts in 2025, but this is the base that goes into that. And we are really happy to report that a lot of our homeownership investments that were proposed in our agency request budget were also included in the governor's budget. And so you can see the list of homeownership investments here. There's with the amounts, so we have two types of down payment assistance that made it into the governor's budget, one paired with lending products and another deployed by culturally responsive organizations. I will note that all of these programs listed here are investments in existing programs so that we can continue offering these services and reaching more people and having larger impact. So these are two down payment assistance programs that already exist. It's a new infusion so that we can continue the programs. This funds the manufactured home replacement program, foreclosure avoidance counseling, the homeownership development incubator program, which funds developers to build new and innovative models of homeownership and funds tribes for homeownership opportunities, among other types of support. There's also a line item for homeownership centers. Many of you on this call represent our vast network of homeownership centers across the state. And so this is a investment to make sure that we can continue supporting you in that work. And then there's also an allocation of $100 million for LIFT homeownership, and we'll talk more about that program during our program updates. So just quick overview of our governor's budget. We can also post the link to the budget in the chat in a second. But with that, I will hand it over to Emily, who's going to announce our guest speaker or introduce our guest speaker.
Hi, everyone. Thank you so much for being here today. As Talia was saying, we have a guest speaker from the Oregon Department of Revenue. Kyle Knox is going to be talking about the first-time homebuyer savings account. So, Kyle, thanks so much for being here, and I'll hand it over to you.
Thanks, Emily. Good afternoon. I'm Kyle Knox, an operations and policy analyst with the Oregon Department of Revenue. And today I wanted to talk about some upcoming expansion for the first-time homebuyer savings account program that we run. Next slide, please. Before we get into the changes coming to the program, I wanted to quickly go over the basics of how the program works now. The Oregon legislature established the first-time homebuyer savings account program to support first-time homebuyers in saving for their first large home purchase by providing a tax subtraction to incentivize that saving. With the affordable housing crisis that we're currently going through, homeownership's harder than ever to achieve for those first-time homeowners. So we really want this subtraction to have as much impact as possible. For purposes of this program, a first-time home purchase is one in which the buyer has not owned a home for 3 years before the purchase date. This allows someone who previously owned a home but hasn't recently to also benefit from the program. So the way it works is that an individual or a couple filing a joint return together can open a specially designated account at a financial institution. The contributions and earnings on that account can be subtracted from Oregon income on the tax return up to an annual limit based on your income. The account holder can continue to contribute to the account for up to 10 years. They must use the funds for a first-time home purchase within those 10 years, or they'll have to add back the income that they subtracted at the end of the 10 years. If funds are removed for reasons other than a qualified home purchase, or some exceptions like death and I think bankruptcy, the account holder must add back that amount as well as pay a 5% penalty for the non-qualified withdrawal. So it offers a helpful saving tool with some tax benefits, but there's also restrictions on how that money can be spent. I am going to mute that person. Hope that's okay. All right, this table shows the maximum first-time homebuyer savings account subtractions for tax year 2024 based on your income levels. These limits have recently been tied to inflation, so in the future they will go up probably every year. As you can see, a maximum of roughly $6,000 can be subtracted per account holder, so almost $12,000 for a couple with a joint account. These amounts can only be subtracted to the extent that contributions are made to the account or earnings accumulate in the account. Essentially, this means that you don't pay Oregon taxes at all on amounts that are contributions or earnings up to the annual limit. These aren't the maximum amounts that can be contributed to the account. You can go over and put as much money as you want in the account, but you only receive a certain amount of tax benefits per year for doing so. Next slide. So the big point of bringing this in front of all of you today is the expansion that's happening in 2025. In the 2024 legislative session, the legislature passed a bill to expand and streamline the program. There are two major changes going to affect January 1st that we hope will make the program much more attractive to potential home buyers. And we're really wanting to get the word out so that any organizations that help people reach that goal can spread the word about the potential benefits. So the first big change is that these savings accounts can now be opened at any financial institution. Previously, taxpayers had to find an institution that offered these accounts, and as some of you may know, participation was far from universal. It could be a struggle, particularly in more rural areas of the state, to find a financial institution that was participating with the program. Now, the way it works is that a taxpayer will be able to open an account at any institution and designate that account in their records as their first-time homebuyer account. This should make the program a lot more accessible and will also give taxpayers the opportunity to choose accounts that fit their needs more, such as choosing a brokerage account or a high yield savings account. Additionally, taxpayers who aren't saving for their own first-time home purchase can now open an account to help a qualified beneficiary save for a home. So in these situations, the account holder will contribute the funds to the account and receive the tax subtraction, but the funds are intended to be spent by a beneficiary, not by the account holder themselves. The hope is that this will allow, for instance, parents to help the next generation save for their first home. It's important to note with the access to these accounts expanding, that an individual may only be tied to one first-time homebuyer savings account at a time. This means you can either hold an account yourself or be a beneficiary, but you can't be both, and you cannot open multiple accounts for multiple beneficiaries or have multiple accounts opened on your behalf. So if a taxpayer is opening an account for a beneficiary, it's important to check with them to make sure they aren't already tied to any other accounts. Next slide, please. Because the program is being expanded and requirements are no longer on the financial institutions to track these accounts, that increases the responsibility for taxpayers to properly document their accounts. Because, to do this, we've created a new form called Form or Home that we intend to make available at the start of January. This form won't be submitted with the tax return, but we would ask taxpayers to fill it out accurately and retain it with their records in case we request it later. We're going to make the form and instructions available at the start of the year instead of later on during the filing season like we normally would, because we'd really like to encourage anyone opening one of these accounts to fill out the form at the time that they open the account, just to make sure that all of the record keeping's in place and they're aware of all the requirements. The form will also be coming with instructions to help educate taxpayers on the benefits and restrictions that the law imposes on these accounts. As far as claiming the actual subtraction, that will continue to be claimed with code 361 on Schedule OR ASC or the OR ASC NP. Form or Home, as well as all the bank statements related to the account, should be retained to substantiate the claim subtraction. And that is basically an overview of the changes coming, and we're really hoping that this will help make this program more accessible than it's been in the past and get potential home buyers to utilize it more. If you'd like further information about these accounts, you can visit our website. I'm also available to answer any questions if you have some, or I'm sure if some come up later, if you get them to Housing and Community Services, they can pass those along. Thanks.
Thank you so much, Kyle. Do we have any questions while we have the expert here? It's not every day that we have someone from DOR at our quarterly partner meeting. if you do have a question, feel free to raise your hand or put the question in the chat. And I'll leave like 20 seconds of silence for anybody to think of a question. Oh, great. I see a hand up. Julie, go for it.
Can you guys hear me?
Yes.
Okay, cool. Is it possible to designate an existing account as a first-time homebuyer savings account, or must it be a brand new account?
You can designate an existing account.
Okay.
You just, like I said, it's still that one account total. So, but as long as you're within that, you'll be able to designate an existing account.
I have a question. Can you hear me?
Yep.
What's the rationale behind a person designating only one family member to save for first-time home buyers when they have more than one children in the family?
Right. As far as the rationale behind there, that was a decision made by the legislature.
Okay.
I know that they were trying to keep it similar to how an individual was only allowed to have one account previously.
Mm-hmm.
I see what you're getting at. There is some potential drawbacks of that limit, but that was the bill that passed. So
Okay. Okay. Thank you.
Any other questions?
yeah, Greg, do you have a question?
There we go. So what I'm hearing in that with the one account, it just really means that only one child at a time. You could stagger the years and you'd be fine. So if they use the money, you'd be open to help the next kid, right?
Right. And you can change your beneficiary on that account. We're not trying to police. We just can't, because of the way the law is written, we can't have an account that's multiple accounts at a time. So you could, like you said, use the account for one kid and then open a new account for another once that account's closed, type of situation.
But would that account close after 10 years or what? I mean,
Yeah, you have 10 years from the time you first open an account. And that did not change with the change of the beneficiary thing. So you still would only have 10 years from the time you open your first time homebuyer savings account. During that time, you could, assist one beneficiary and then another. But it does remain within that 10-year limit. All right, looks like that's all we got.
Great. Well, thank you so much, Kyle. We will post this link in the chat, and we also post these slides afterwards. So these slides are available to anybody on the Homeownership News and Events website. Sounds like you know who to ask if you have more questions that come up after this. But thanks so much for joining us today.
Yeah, thanks for having me on.
Great. So we're going to move into program updates, and we will start with the Homeowner Assistance Fund. Let me actually make sure that Ryan is on to give these updates. Oh, you are. I see you. Great.
Yeah. Hi, Talia. Hi, everybody. Thanks for joining us today. My name is Ryan Vandenbrink. He, him. I work with the Homeowner Assistance Fund team here. We have been operating this for a couple years now, and we are excited to announce that we are in the final stretch. We have closed the program to new applications. We are processing our final applications. We will be making our final payments this next February, and we'll be making those payments for the March due dates. Homeowners will receive notices of all of this, letting them know that they'll be in charge of resuming their own payments in April. And then I am also here in case there are institutional partners on the call, because we will be hoping for your close collaboration in getting payment confirmations and account reconciliations fixed up so that we can make any short payments by March of 2025. I'm excited to say that we are projected to spend over 74 million on homeowners in the last couple of years, and we have focused our assistance on those that are the most at risk of foreclosure or loss through an HOA, county tax foreclosure, things like that. So we've helped almost 27 or 2,800 homeowners avoid foreclosure in the state of Oregon. So good news and sad news that we are closing down, but it's been really great and rewarding experience. So thank everybody on this call for their collaboration if we've been working with you and homeowners that you're working with.
Thanks so much, Ryan. Any questions for Ryan about the closure of half or what happens next? Okay, thank you. Great. The next program up is, oh, okay, hold on, I see a question. Okay, it's not showing up now. Okay, next up is Hope. So I will pass the mic over to Alicia.
I didn't realize I was speaking. Sorry about that. Alicia Howell. I manage the homeownership assistance programs. Just to kind of let you know where we're at with our down payment program, we have our current contracts that are valid through the end of May. So the money that was issued out in February of 23, that program is closing May 31st, 25, with hopes in the next legislative budget that we will have more DPA funds to go out within a relatively short period of time after that program closes. And our homeownership center RFA that went out in 21 will goes through December of 26. And as you know, the foreclosure avoidance counseling for people at risk of foreclosure or participating in the Oregon foreclosure avoidance program, those contracts go through the end of the biennium, June of 25. We are working currently with DOJ for the Restore Health and Safety, Veterans Restore Health and Safety and Down Payment Assistance Program. We're putting out the RFA for veteran fund only for Restore and for down payment assistance. And we're hoping to see that RFA open the early part of next year. So we're currently working with DOJ, don't have a permanent timeline on that one just yet, but we're on the home stretch. So hopefully we'll have that out sometime early next year. So that'll be your gift to us for the new year, is having that new RFA open. So thank you.
Thanks, Alicia. And next up, we have Jessica to represent our homeownership development programs.
Thanks, Talia. Good afternoon, everyone. I'm Jessica McKinnon. I use she, her pronouns, and I'm the Senior Homeownership Development Program Analyst here at OHCS. I manage our homeownership development financing programs, and I'm happy to be here to update you on what we've accomplished and what we're working on right now. The first thing is that we wrapped up our 2024 NOFA in November with Housing Stability Council approving our last few projects. I'm pleased to report that we were able to award almost $45 million in LIFT and LIFT supplemental funding to 15 different projects. And these projects will bring 298 new affordable homes to Oregon in the next few years. The second item is that we've been working with the policy team on the design and implementation of the Moderate Income Revolving Loan Program, or MERL, that was a part of Senate Bill 1537 last year. This is a program that'll be run by your local jurisdictions, and without getting too into the weeds, the way that it works is that OHCS will loan your jurisdiction funding to support a development project, and then the jurisdiction will essentially repay the loan using the increase in taxes from the property after the housing is built. This program is going to be available for homeownership projects if your city or county wants it. The anticipated launch date should be February sometime next year. So if you're interested, please keep your eyes open for any announcements and also keep in contact with your city and county to see if and when they may choose to actually implement the program. The final item here is that we are hard at work right now getting ready for the launch of the 2025 NOFA. We should have a little over 40.3 million, including what's remaining from the 2024 NOFA. If you haven't attended any of our many engagement sessions or updates, there are going to be some really big changes next year. The first is that we'll be moving to a per unit subsidy model rather than tying the award to the value of the land. We think that this will offer more access to rural developments and dense developments, and we hope that we'll see a greater variety of projects in a greater variety of locations in Oregon. We'll also be launching the Oregon Affordable Housing Tax Credit for limited equity co-ops and for manufactured home parks that are also applying for LIFT. There'll be more about that in the NOFA posting in January. I won't go into any detail today. Can we go to the next slide? All right. So this slide here is just a quick information dump about the upcoming NOFA. I won't go into too many details. Most people who are interested who have already heard a lot about it at this point. But the blue table on the left is the maximum award an applicant can receive per unit based on bedroom size. And rural developers can receive a slightly higher maximum award. The green table on the right shows our soft set-asides for the coming year. So about 20% of our funds will be set aside for small and emerging partners. 30% will be set aside for counties that have 20 or fewer homes funded by LIFT. And then half of the funds will be available to all applicants immediately. The rest, if they don't get spent, will roll over into that general applicant pool. We expect the NOFA to launch on January 6th, and we'll start accepting pre-applications at that time. Throughout January, we'll also host a few training sessions for interested parties. We actually have those dates a little later in the presentation. We won't begin accepting applications until February 24th, since this is a first come, first served application. This allows everyone to take the time they need to complete the application, and this should get us better quality applications, and hopefully nobody feels too stressed out or rushed trying to be the first one past the finish line. March 10th will be the first soft deadline for the first cohort of applicants. Assuming that there are still funds available after that first cohort, we'll continue to accept applications until May 12th, which is when the NOFA closes. We expect to announce awards for the first cohort in May and then the second cohort in July or August. And that's everything for homeownership development. So happy to pass things back.
Thank you, Jessica. That was a lot. Any questions? We do have a substantial presentation coming from our homeownership lending department or section next, but I just wanted to take a quick pause before we go on to the next topic. If there are any questions about HAF, HOPE, or homeownership development. Okay, great. Then Scott, I will hand it over to you.
Excellent. Well, good afternoon, everybody. Who has control of the slides? Next slide. Oh, hey, there it is. I'll be darned. And this is the nice compact version. So I'm so excited to bring this all to you guys. So we worked long and hard on this. I think we've been working on it since about the middle of last year, but we have just rolled. It was on November 4th. We rolled our revision to the Flex Lending program, bringing in our qualifying first time home buyer program. Or product actually that's going to basically it will supplant the legacy bond program, which you guys know is the Oregon Bond Residential Lending Program. So Flex Lending now has two products, First Home and Next Step. And we basically built this grid that you are more than welcome to have a copy of later on, just to kind of let you know what's changed, what we're doing. So both the legacy bond and the First Home product are what we call IRS qualifying, and they have the recapture requirements associated with it. I'm sure many of you guys are already familiar. And then as we collaborated with you guys, all of the first-time home buyers do require home buyer education. Let's see here. Basically, the alignment of First Home with the Next Step is allowing more lenders to have access to the product, and it is allowing DPA, and we'll talk a little bit more about that, I think, on the next slide, if I remember right there, Talia. But here's what we want to let you know. Minimum FICO is 620 on First Home. There are still a few lenders that have not transitioned from the legacy bond program over to First Home. They are in the process of working on that. So minimum FICO is 620. Purchase price limits and the income limits follow the counties for the Next Step product. And I don't know if you guys are familiar with it or not. That's what we used to call flex lending. It has a global income limit of $125,000 with no purchase price limit. And this is where I think is probably the most important to talk to you all about is qualifying income. Our legacy bond and our First Home qualifying first time home buyer product have a household income limit, whereas the Next Step product is what we call qualifying income. And that is borrowers that are on the mortgage loan or how we qualify that $125,000 cap. Want to talk to you a little bit about underwriting requirements. You are going to follow agency guidelines. There is manual underwriting is allowed on government loans. It's 640 and above for the First Home and Next Step. You follow agency guidelines for that legacy bond. Debt to income ratio, max DTI on legacy bond, you do follow agency guidelines. For Flex's First Home and Next Step, it's 50%. Continuing on with non-occupant co-borrowers, you can't have non-occupant co-borrowers on our qualifying first-time buyer program. You can on Flex's Next Step. You just need to make sure that the income limit does apply, so that $125,000 applies to everybody that is on that mortgage loan, including non-occupant co-borrowers. We did bring across when we rolled out First Home a rate advantage option that is still available. I think this morning that ran 5 3/4 on government and 6% on conventional. Let's see here, max CLTV. This is where we're getting into the stuff that I'm excited to bring to you guys. So with our legacy bond program, you were limited to 80% LTV on conventional loans with 105% CLTV. With First Home and Next Step, you can get mortgage insurance now. So you're 97% on conventional with a 105 max. And then FHA, VA, USDA. Actually, hold on. Yeah, I'll say FHA, VA, USDA. So FHA is still 96.5% LTV, and you just follow HUD's guidance for CLTV. And VA and USDA are 100% following VA and USDA's guidelines for CLTV. ADUs, we are very excited to talk about. We couldn't allow for ADUs with the legacy bond program. We did have the ability to open that up for First Home, and it has always been available for Next Step. All you got to do is follow agency guidelines for Fannie, Freddie, FHA, VA, USDA, and you're good to go there. I talk really, really fast. I hope you guys have lots of great questions. Let's go to this next slide. Okay. Down payment assistance. So this is where things really shine. So when we rolled out First Home, that was our main goal, was to be able to allow down payment assistance to be paired with a qualifying loan. And we were able to accomplish that with First Home. We have created a pretty hard-hitting matrix, I would say, because what we wanted to do is we wanted to encompass and include as many people as possible. And here's how this works. If your borrowers are below 80% AMI, your second is a silent second. There's no payments, there's no interest due until the borrower sells the property, no longer occupies the property, or refinances the property. And that DPA comes in two forms, either 4% or 5% DPA. That 5% DPA is what we call our focus demographic DPA. If you are not familiar with it, that is OHCS's DPA that offers more favorable terms, and it's for borrowers that it's aimed to hit underserved communities and communities of color. That is borrowers that are single parent households, borrowers with members that are either seniors or have a disability, borrowers with a higher front end debt ratio. And I'm sure I'm missing something on there. There's a form that we can include a link to later on, or if somebody wants to put that in the chat, that would be great. If your borrowers are over 80% AMI, up to 120% area median income, that loan is repayable. It is repayable at 1% over the note rate of the first, and the 4% DPA is a 20-year repayable term. The 5% focus demographic DPA is a 30-year repayable term. We extended that term to be able to drop that debt ratio down just a little bit to allow people to buy a little bit more house. And then if you have borrowers that are in excess of 120% of the area median income, we still offer DPA. It is a 4% DPA, but the repayment term is 10 years. And that mirrors with Flex. Flex's First Home and Next Step, they're exactly the same. So with the exception of Next Step does have a cap of $125,000. The rest of our guidelines are based on the income limits that the IRS establishes for us. Talia, do we have another slide as I'm talking really fast? Because I want to kind of talk about how well this has been received.
This is the last slide, so go for it.
Okay, so here's how excited we are about this. So we would do 20 or 30, maybe 40 locks in a month. Since we launched, we've locked 77 loans for $25.8 million with over $675,000 worth of down payment assistance. So we are super excited about it, and I want to take some questions. What do you guys want to know? Hi, Julie. Can she just come off mute? Can I just run with it, Talia?
Yeah.
So,
Hi, Scott.
Hi there. How are you?
I'm well. How are you?
Doing good. Talk to me.
Great. So, I am with a company that's been waiting very patiently to be onboarded.
Yes.
ETA on that? Any idea when you're going to be opening the door to those of us who are on the outside right now?
No, so we're not purposefully keeping people out. I'll tell you, we had a very methodical process for how we rolled this out. We rolled this out to people that were using the legacy bond program and wanted to transition first. They got the first option. They had to be approved with our flex lending program first, and they got the opportunity to pilot it. As that went on, we actually added 2 lenders that that have no experience with a qualified loan product. And what we're doing right now is that we're making sure, quite honestly, we told them they were guinea pigs in the best possible way, but we knew that as much as we planned, and we put, like I said, over a year of planning into this, right? One of the things that we knew is that there's something that we're going to miss that's not going to go perfect. And things have gone actually exceedingly well, better than my expectations. But to be quite honest with you, we want to get through our first few. So these new First Home loans are securitized, which means they get put into a mortgage-backed security. And we need to get through our first couple of securitizations before we know that we've got all of our policies and procedures in order. So we probably anticipate that sometime in the first quarter, maybe the end of the first quarter before we start adding more, making sure that we've got all of the policies and procedures in place to make sure that we can handle the capacity.
Well, if you want another guinea pig, I have originated hundreds of Oregon bond loans under the Legacy program with a former employer, and my company has done lots of qualified income lending in all sorts of states. So
Well,
just
I'll
raising
tell
my
you.
hand as a guinea pig.
Let me tell you what we did do, just so that you know that it was fair, right? So the very first lender that did not have legacy bond experience was Directors, because they were our first lender that got approved with flex lending. We've been working on getting Encompass built out. For those that you don't know, Encompass is the 800-pound gorilla in the room. They're the loan origination software system. So there is a little bit of a bottleneck there. The next thing that we did, because there were a few challenges with that, was we actually reached out to the next 5 lenders and said the first one to email us back that wants to go come aboard, we'll bring them in. And so at this point, we're holding fast, seeing how things go, and like I said, securitizing our first loans and making sure things are smooth for when we bring you aboard.
Gotcha. Can I ask you a more nuts and bolts question?
Yeah.
I'm very pleased that you are able to allow properties with ADUs under the first home program. That was always a kind of a thorn in our side with the legacy bond program. And I also had some clients who wanted to purchase properties that had what they would call back in the day a canning kitchen, like a split level with a second kitchen in the basement, things like that, that had been sticking point. So it sounds like, if an ADU is okay, I assume a single family residence that has a second kitchen in it is going to be acceptable under first home as well.
We have tried really, really hard to make sure that we brought our programs and products up to current agency requirements, and we're gonna continue to follow agency guidelines as best as we can. So yes, at this time,
Okay.
that is exactly where we're headed. We do collaborate. So Idaho Housing is our master servicer, so they will service all of these loans for first home and next step. And quite honestly, when we have any challenges with that, we will bounce it off of them. Say, hey, how do you guys, they have billions of dollars worth of loans under servicing, and we collaborate with them. And quite honestly, the other Western states, just to make sure that what we're doing isn't super out of line for what's going on. So, yep.
Okay. And then
Great question.
semi-related question. Obviously, you are not allowed to rent a property if, while the first home and or legacy bond loan is in place. You are allowing ADUs, however, which is often a source of rental income. People also have housemates. And even back in the day when I was funding a lot of Oregon bond loans, I never got a clear answer on whether or not that would count in your minds as rent.
Yeah,
is collecting
you're
rent
not
from
going to be renting
housemates.
these. These are for
Okay.
this is
Family,
along the lines
extended
of
generation,
generational living.
multi-gen.
Yeah.
Perfect.
Yep.
Okay. That was kind of my presumption,
Great
but I just
question.
wanted to make sure. And roommates, would that be the same thing? I buy when I'm all by myself. I have a second bedroom. I want to rent it out to a housemate.
Nope. Yeah, you are not to turn the property into an income producing property.
No rent, even if you're living there. Okay, thank you. That's something I've wondered for literal decades. I will stop
It's a good
talking
question.
now.
Yeah, the
Thanks.
IRS, quite honestly, here's the catch. This isn't OHCS trying to be strict. The
Yeah, no, I
IRS
get
is
it.
giving
I know
us
it's
guidelines.
it's
Yeah,
same
okay.
deal
Yeah,
with
yeah.
like ODVA, right? They've got the same handcuffs you guys do. I get it. Housing bonds.
Yep. I would call it guidance. I don't know if I'd call it handcuffs, but I know what you mean, right? I mean, that's really it. Is that we will do what they allow us to do. We won't violate what they don't allow us to do, right? And we do. When you guys ask questions, there are sometimes that we get questions that we haven't been asked in a while. I'll literally fire it up to the people that have been around for 10 years and say, hey, when was the last time we actually asked our legal counsel about this? And we'll actually revisit. So it's definitely not falling on deaf ears. Like I said, good question.
Thank you.
I think we've got somebody else. Is it Adina? I hope I'm not slaughtering your name.
No, you said it correctly. Thank you. I actually have two questions. So I'm with Habitat for Humanity in Salem, and we are about to, within the next month, probably 2 months out, we're going to close on our very first time we're using Oregon bond on one of our properties. So I'm just confused. Is the legacy bond still available to us for those home sales?
Talia and I will probably tag team on this conversation because Talia's worked very, very hard when it comes to, I assume you're saying a LIP funded property, correct?
It's actually not LIP funded. It's the HDIP, the initial HDIP that wasn't
So
LIFT. It wasn't
so it's
connected
just a
to LIFT.
CLT?
No, not that either.
Oh,
So there's an
well, then you can
affordability
do that.
term, but it's the 20-year affordability term under the HDIP.
Okay, I'm going to defer to Talia on that one. I think we should probably take that one offline because it's a good question. But I think that we want to make sure that we're covering our bases. It's the first time I've heard of an HDIP by itself. So
great. Yeah, glad to be a unicorn on that.
Love it.
And then so we'll talk after or later. And then Talia, can you go to the next slide? I had a question on that slide. So here it's describing down payment assistance terms with silent seconds. So I'm just wondering where that down payment assistance comes from, and also with our mortgages, we typically have a silent second that we hold as Habitat. So I'm wondering how, I just want to understand how the silent second here, how it all kind of lines up.
Okay. So are you talking about lien position or
yes.
what?
Position mostly.
Okay. So OHCS will go first and second when it comes to lien position if you're using our DPA. There, quick and clean.
And then the DPA is like through that, what was described earlier as the DPA program, right?
Yep.
Okay, great. Thank you.
No, it's a good question. And I know that it sounds like we've got some time constraints, so I don't want to take too much more time, Talia, unless there's somebody else that has a question.
I'll just chime in briefly, Adina, for your HDIP project. Since HDIP doesn't encumber the land in any way, there's not really any limitations on mortgage products the way that LIFT has. So as long as you meet the guidelines of Oregon bond, the legacy Oregon bond, or any of Next Step or First Home, then you're fine. It doesn't have the same complications that other LIFT program LIFT developments in the past used to have, and we've now hopefully solved for that as well. So your home buyers are able to use whatever product they're eligible for. Any other questions? Joe, does your cat have a question? We didn't hear your cat, but okay, great. Well, thank you so much, Scott. I think it's really helpful to have you in this space. We all really appreciate having this time where we can get together with a broad cross-section of our partners. This is really the only space in which we see lenders and developers and folks from homeownership centers and other community organizations, and then we have our staff on the line. So it's just really helpful to hear what you're thinking, and then also have a platform for some of our staff to share just the updates and hear your reactions. So we're glad that you have taken the time to spend this afternoon with us. I know there have been a bunch of other network meetings today, so people have had packed days. So that's it from us, and we wanted to open up the floor for any updates that partners want to share. So feel free to come off mute and share if you have an update or event that that you want to tell folks about. Feel free to put it in the chat. And then while we're waiting for folks to come off mute or share opportunities, I'll also just put up on the screen our upcoming events in the next couple months. So every month, the first Friday of the month, the agency has a Housing Stability Council meeting. These are public meetings, and the Housing Stability Council is the oversight body of OHCS. And so homeownership sometimes goes to Housing Stability Council to present briefings or items for approval. This coming Friday, we will be there presenting our LIFT framework and our Oregon Affordable Housing Tax Credit for Homeownership framework for their approval. If anybody was there last month, be the same, similar presentations, just now we get formal approval. For our development programs, Jessica spoke about the January 6th NOFA launch date. You'll see here some other trainings and meetings related to that. And Jessica, if you don't mind putting those registration links in the chat. And then our next quarterly homeownership partner call, so this all over again, is March 6th. Not all over again, new topics, new ideas and information, but it will be March 6th. So now that I got through that, I see a hand up. If you want to come off mute, I can't see who it is. Great.
Oh, it's Brian, Housing Oregon. Hey, thanks for reminding me about the Housing Stability Council meeting. I signed up, but I haven't looked at the agenda yet. So is this your presentation to try and finalize the work that the work group at Department of Justice and OHCS to make formal changes to the LIFT program? That's this meeting?
Yeah, yes, more or less.
Great.
It's a little bit more detailed related to the NOFA, but a lot of the fundamental structural changes from the work group are embedded in that. And we gave a briefing last month on the work of the work group. We'll skip over that this month because we don't want to repeat too much. But yes, this will be the final approval
and they'll vote
for
on
all the amazing work that the work group accomplished.
All right, thank you.
Thank you, Jessica, for posting those in the chat. Any other updates from partners? Okay, well then, if there's nothing else, Keeble, I'll pass it back to you to close us out for our last partner meeting of the year.
Thank you all again. I would just like to reinstate what Mr. Shaw said about the excitement of lending and all the stuff that we're doing also in home, in the development division of our team as well. So we're really excited about what the NOFA is going to look like next year and how we're going to do the work. So really excited, really grateful of all the team members here at OHCS that went above and beyond to get this thing that we've been doing above and through the finish line. And I just want you all to enjoy the rest of the holidays and the time that you have to spend with your loved ones and family. So it was really good being in this space this year and looking forward to see you all next year. So have a good day and have a good year.
Thank you, everyone.